Is everyone looking in the wrong direction? Well, all eyes are on Wall Street. A giant is quietly waking up. Today, I'm going to show you why China's economy is starting to accelerate again, why its stocks are incredibly cheap right now, and I'll give you 4 simple ways to invest using ETFs for the next 5 to 10 years. The Chinese stock market is trading at nearly half the valuation of the US market. But not all Chinese investments are the same, and one of these ETFs gives you access to companies that most foreign investors can't even touch. Let's start with the big picture. Most of the world's major economies are hitting the brakes. They're raising interest rates to fight inflation, and that cools things down. China is doing the exact opposite. They are in an expansionary cycle, stimulating their economy. This creates a powerful tailwind for their companies. And the best part? The prices. Valuation is simply the price you pay for $1 of a company's earnings. Right now, the broad Chinese market trades at around 15 times its future earnings. The S&P 500 in the US? It's much more expensive. This valuation gap suggests that Chinese stocks have more room to run and potentially less room to fall over the long term. Investing in China gives your portfolio real diversification. When the US market zigs, an accelerating China might zag. This can protect your capital and open you up to different growth drivers. I know this is a contrarian view. If you appreciate this kind of analysis that goes against the herd, take a second to subscribe to the channel so you don't miss the next one. Now, let's talk about the elephant in the room, risk. Yes, there are political and regulatory risks in China. We've all seen the headlines. But in the market, risk is all about price. My view is that these risks are more than factored into the current stock prices. The fear has created the opportunity. The best time to look at a market is often when nobody wants to touch it. This is not a get-rich-quick scheme. Investing in China is for the patient investor with a 5 to 10-year horizon. So, how can you do it simply and effectively? Through ETFs. Exchange-traded funds are baskets of stocks that give you instant diversification. Here are 4 I'm watching. First, for general exposure, you have ETFs that track the CSI 300 index, like the Xtracker's CSI 300 Swap ETF. Think of this as the S&P 500 of China. It's a complete picture of the market, holding giants like Tencent and Alibaba. It's the perfect starting point. But this is just your foundation. Later, I'll show you a more exclusive way to invest in China's top companies. Second, for a focus on the domestic economy, look at the iShares MSCI China A ETF, ticker CNYA. This fund invests in A shares, which are stocks of Chinese companies listed on the mainland in Shanghai and Shenzhen. This is your direct bet on the growth of the Chinese middle class and the real internal economy. Its valuation is also very reasonable. Third, for higher growth potential, there's the CraneShares CSI China Internet ETF, ticker KWEB. This one is all about China's tech giants. It's more volatile for sure, but its valuation is incredibly compelling. It's trading at around 17 times forward earnings, far below its historical average of 30. If you believe in the long-term digitization of China, KWEB offers explosive potential. And fourth, my favorite, for its unique access, the CraneShares Bosera MSCI China A50 Connect, ticker KBA. This ETF holds the top 50 mainland companies, the heart of the country's financial and technological sectors. Its key advantage is offering access to stocks that are typically harder for foreign investors to buy. It's the most authentic way to get exposure to the core of the Chinese market. So, how do you put this all together? A reasonable allocation for a global portfolio could be between 10% and 15% in China. You don't have to pick just one. You could build a core position with a broad market ETF and add smaller satellite positions in KWEB for tech growth or CNYA for domestic exposure. To recap, China is accelerating while others slow down. Its valuations are attractive, and it offers powerful diversification. The risks are real, but they appear to be fully priced in, creating a long-term opportunity for patient investors. If you found this breakdown useful, the best way to support the channel is by hitting that subscribe button. Now, I want to hear from you. Are you already investing in China, or are you considering it after this analysis? Let me know in the comments below.